Kyle, how much money does someone need to get together if they want to buy their first home?
So for a first-time home buyer, there's a couple different options. There's a really nice conventional mortgage, which is a little bit more difficult to qualify for than an FHA mortgage, but it's usually conventional loans are going to require a lower debt to income and a higher credit score. But if you qualify, 3% is a down payment. So you can get 97% of the home and a conventional mortgage done.
Wow.
When you're buying the house, there's also going to be closing costs.
Mm-hmm.
Closing costs, it ranges depending on the value of the home that you're buying. It's usually between 2 and 4%, depending on. If you have a lower credit score, sometimes there's additional interest rate, origination charges that you have to cover. So 2 to 4% is a pretty safe range. For example, if the house is only $100,000, there are certain fees and taxes that you have to pay to the county.
Yeah.
And so a $100,000 house, it could be 5 or 6% of that because it's a smaller loan, so it's a larger percentage. But if you're buying $1 million house, it's really like 1%. So the more expensive the home, the smaller the percentage. Typically, for an average, first-time home buyer buying a $250,000 house, closing costs should be around $5 or $6 grand. Now, there's also something called prepaids, or we call them impounds. And in addition to the title fees, the lending fees, the recording fees, the transfer fees, all the basic standardized fees. In addition to that, we also are going to have to build an escrow account, which is essentially a savings account on behalf of the buyer of the property and the bank. And the buyer of the property is agreeing to pay about a year's worth of property tax up front and a year's worth of insurance up front. It's like a piggy bank to guarantee to the lender that, hey, if you miss a mortgage payment, well, they still have that impounded amount of money to continue paying taxes. That can be another easy 3-4 grand. And sometimes people get confused because they say, hey, I heard closing costs, are only 5 or 6 grand. Well, that's true, because I wouldn't call escrow or impound, advance payments. I wouldn't call that a closing cost because it's your money. And for example, if you buy that home and then let's say next month you win the lottery and you want to go buy a mansion and you don't need this house anymore. If you sell it a month later, that $3,000 worth of tax and insurance that you put in escrow, you're going to get that refunded back to you. So it's really your money, but it is a cost. So in a conventional mortgage, first-time home buyer, you have 3% down payment, 2 to 4% of closing costs. Excuse me. And then your escrow, your prepaids, and that's basically what it would all come out to. In an FHA mortgage, if your debt to income is a little higher, your credit score is a little lower, there's a lot more flexibility with FHA. It's a 3.5% down payment. So you still have an amazing opportunity, even if you have credit challenges.
So what kind of credit does someone need, just as a quick side note, to qualify for an FHA
Of course.
loan?
So FHA, 500. If you're a 500 credit score and you have a good file, meaning you've got some good parts of your good job time, good, reserves, maybe you got some extra money in the bank, we can get you qualified, but it's a 10% down payment. If you're a 580 and up, you, on that score, you should qualify for 3.5% down payment.
So to get 3.5% down on an FHA loan, all you need is a 580 credit score.
Well, you need a 580, but you also need income, assets, verification. We have to, there's obviously other parts, but as credit score alone, 580, that's the qualifier.
So if someone's working hard, they've got a good paying job, they're consistent, but their credit just isn't great. It's only 580. They can still get a great rate on a loan and only have to put 3.5% down.
Oh, absolutely. The interest rates, especially with FHA, you could be a 580 credit score and still have a 3-point-something interest rate.
Wow. I mean, I think a lot of people just don't realize that.
Oh, 100%. For example, if you go to a car dealership and you're a 600 credit score, you'll pay 10, 12, 14%. For a very short amount of time on a liability that's just going to lose value. But in a home for 30 years, you still can get very similar rates to somebody with a 700 credit score. Huge opportunity.
Amen. I mean, I'd say that if you had to pick between owning a new car, like going and financing a car, or going and financing a house, like maybe just like buy a used car cash and have a home, because it's actually an investment. You're going to get ahead.
100%.
When you own a home, it's an asset. When you own a car or you're financing a car, it's really a depreciating liability.
Yeah, you know, 100%. Yeah.
But so many people they're willing to go finance a car when they could take that same money and go put it towards a home and have something that's appreciating in value potentially.
Definitely. No brainer.
Right on. All right. Well, thank you, Kyle.
Of course.